hidden connection, AML and fraud in 2025. This fake meeting cost a company $25 million in just minutes. In 2025, the line between fraud and money laundering has completely disappeared. Welcome back to the channel. Today I'm breaking down exactly how anti-money laundering and fraud are converging, and what this means for your financial security. After analyzing insights from top financial crime experts and recent case studies, I've identified the key patterns that are reshaping how banks protect themselves and you from increasingly sophisticated attacks. The techniques I'm about to share are being implemented by leading banks right now to protect assets, and understanding them gives you crucial context for the financial world we're all operating in. Here's what we'll cover. First, we'll explore how fraud schemes have evolved in 2025. Then we'll examine the technological advancements changing detection. Finally, I'll share actionable strategies that financial institutions are implementing today. Plus, I'll explain why one country's approach is being called the gold standard that everyone else is rushing to copy. The evolving fraud landscape. Let's start with how fraud has changed. Financial institutions now deal with two main types of payment fraud, and the difference between them is crucial. First, there's unauthorized payment fraud. This happens when criminals hack accounts and make payments without the customer knowing. These are relatively easier to detect because the digital footprint often differs from the legitimate user's patterns. When banks spot these suspicious activities, they contact the customer, who immediately confirms they didn't make the transaction. But the second type is where things get complicated. Authorized payment scams. These involve victims who willingly make payments after being tricked. Think romance scams, investment scams, or fake tech support. The victim genuinely wants to make the payment. As one expert put it, from a forensic perspective, everything we see about the customer making the payment is perfect, because it is the customer making the payment. Banks report massive growth in these authorized scams, making them especially difficult to combat. The Asia-Pacific region, particularly China and Hong Kong, has become an epicenter for many fraud operations. According to IC3 statistics, these areas are significant destinations for stolen funds. A disturbing trend involves fraudulent call centers in Southeast Asia that systematically target victims through social media. Their operation is methodical. Initial contact through social media, building relationships over weeks or months, eventually requesting payments, quickly moving money across multiple accounts and borders. But here's where it gets even more concerning. AI has dramatically changed the game. In Hong Kong, criminals use deepfake technology to create an entire committee of fake executives, convincing an employee to send approximately 25 million Hong Kong dollars. What's worse, AI tools now make perfect document forgery available to anyone. Services costing around $200 per month can help create convincing fake documentation that once required entire departments of specialists. As one expert described the situation with deepfakes, this is a drone fight where we're just carrying guns. Our defenses simply haven't caught up to these attack technologies. The convergence problem. This brings us to a critical question. Why are traditional banking defenses failing against these threats? The answer lies in how banks have traditionally organized themselves. Fraud and money laundering have been treated as separate problems with separate teams, systems, and approaches. But these crimes are inextricably linked. Fraud generates illegal money that then needs to be laundered. They're two sides of the same coin. A fundamental difference exists between traditional money laundering and fraud-related money laundering. Traditional laundering involves criminals cleaning their own illegal money. Fraud laundering involves stolen money from victims, creating greater urgency for quick action to enable recovery. This difference in urgency reveals a critical weakness in how banks respond. Traditional AML monitoring typically operates on a 30-90-day transaction monitoring cycle. The focus is on finding suspicious patterns after the fact. Effective fraud prevention, however, requires real-time intervention before money leaves accounts. As banking transaction speeds increase, particularly with instant payment systems, the window for identifying and stopping fraudulent payments keeps shrinking. This creates a critical vulnerability that criminals exploit every day. Enter money mules, people who allow their accounts to be used to move fraudulent funds. They come in three types. Unwitting participants who don't realize they're helping criminals. Witting participants who suspect something is wrong but proceed anyway. Complicit participants who knowingly engage in criminal activity. There's now an active market for legitimate bank accounts, particularly on social media. University students returning home are one group selling accounts they no longer need. The economics vary widely. In Singapore, where controls are stricter, accounts sell for up to $2,000 each. In places with less oversight, prices are much lower. Traditional AML controls simply can't detect when legitimate accounts change hands. The systems aren't designed to spot the transfer of control when legitimate accounts are compromised or sold. The technology revolution. So how are banks fighting back? Through a technology revolution that's changing detection methods. Artificial intelligence and machine learning are transforming fraud prevention in AML in three key ways. First, enhanced predictive analytics. Banks are moving from reactive to proactive monitoring by analyzing more factors, including customer behavior, transaction patterns, and external data to predict risks before they materialize. Second, behavioral risk scoring. This creates dynamic, real-time risk profiles for individual customers that adjust continuously based on past behaviors and transaction history. Third, self-tuning models. Machine learning algorithms automatically adjust rules based on emerging threats and previously unidentified patterns of suspicious activity. With proper implementation, these AI systems reduce false positives by up to 45% while maintaining or improving detection rates. This means fewer legitimate transactions get flagged while more actual fraud gets caught. Banks are also seeing operational savings of 50% or more through automation of data collection and case analysis. Perhaps most importantly, the machine learning algorithms learn from past mistakes and continuously refine their decision-making, improving accuracy over time. But technology alone isn't enough. UK banks are implementing bidirectional monitoring, placing holds on incoming suspicious payments until their source can be verified, not just watching outbound transactions. Network analytics are also changing the game. When a victim at one bank pays a suspect at another bank, this information triggers alerts to identify other potential victims and suspects across the financial system. The regulatory puzzle. Different countries have taken vastly different approaches to addressing these interconnected threats. The United Kingdom has shifted most liability to banks, with victims receiving nearly 100% reimbursement within 7 days of making a claim. However, this hasn't reduced fraud losses, suggesting that shifting liability alone doesn't solve the problem without broader accountability. Australia is developing frameworks requiring telecommunications companies and digital platforms to register with the Australian Financial Authority, spreading responsibility more widely. And this is where Singapore's revolutionary approach comes in. Singapore is frequently cited as the leading model for information sharing and collaboration. Their system allows financial institutions to share information preemptively and enables police to directly freeze accounts when fraud is suspected. This collaborative model recognizes that financial crime prevention requires unprecedented cooperation between financial institutions for transaction monitoring, telecommunications companies for preventing fraudulent messages, social media platforms for controlling initial contact, government agencies for coordinating responses. As one expert noted, if everybody, including the customer, isn't brought into the ecosystem to share responsibility for eliminating fraud, we're never going to succeed. Future-proofing financial security. Looking ahead, the future of financial crime prevention lies in integrated approaches. First, unified data architecture. Banks are consolidating data across traditional silos to enable comprehensive monitoring that doesn't distinguish between fraud and money laundering, but focuses on suspicious behavior regardless of category. Second, signal-based intervention. This focuses on what action is appropriate based on data signals, regardless of whether it's categorized as fraud or money laundering. Third, behavioral analytics that leverage patterns of legitimate behavior to identify anomalies that may indicate fraud or money laundering. What's fascinating about this shift is how it represents a complete change in thinking. Instead of treating financial crimes as separate categories requiring different responses, the most effective institutions now see them as interconnected threats requiring coordinated action. This requires information sharing frameworks that let financial institutions exchange suspicious activity information in real time. Co-location of teams from banks working directly with law enforcement. Standardized communication protocols for sharing data about suspicious activities. At the government level, comprehensive strategies like the UK's Economic Crime Plan set clear objectives for both public and private sectors, ensuring that different regulatory bodies have aligned approaches. The conclusion. To sum up what we've covered, fraud and AML functions are now inseparable aspects of the same problem. Traditional approaches that treat them separately are failing to address increasingly sophisticated attacks. The shift toward real-time detection is essential, with AI and machine learning providing the tools to make this possible. And meaningful solutions require collaboration across the entire ecosystem, from banks to telecom companies to social media platforms. Now you understand why financial institutions are restructuring their entire approach to these interconnected threats. You've seen the specific technological and organizational changes happening right now that will shape financial security for years to come. If you found this analysis valuable, hit the subscribe button for more in-depth financial intelligence. I publish new videos every 3 days examining the trends reshaping our financial world. Share your thoughts in the comments about how you see this convergence playing out. Which aspect do you think poses the biggest challenge for financial institutions? Next week, I'll be diving into how specific AI tools are being deployed to prevent these crimes. Until then, stay safe, and I'll see you in the next video.